How does the entire economy really work? In this narration, I'll explain Ray Dalio's economic machine in detail, step by step, with examples and practical takeaways you can use to think about markets and your money. At its core, the economy is simply people making transactions. Every time someone buys a coffee, hires a plumber, sells a widget, or pays for a subscription, a transaction happens. Add up millions and billions of those transactions and you have economic activity. The total number and value of transactions determine whether the economy is expanding or contracting. When transactions rise, businesses earn more, workers get paid more, and the level of economic activity grows. When transactions fall, businesses shrink, layoffs happen, and the economy contracts. That simple truth, economy equals transactions, is the foundation of everything that follows. But transactions alone don't explain all the big swings we see. There is a second major force: credit. Credit allows people and institutions to spend more than their current incomes. If a household, a company, or a government borrows money, it can increase spending today, which increases transactions and pushes the economy higher. Credit acts like an accelerator on a car. When you step on it, economic activity speeds up. When credit is easily available and cheap, borrowers spend more, investors take on risk, and asset prices rise. When credit tightens or becomes expensive, spending falls, asset prices drop, and the accelerator releases. Understanding credit requires distinguishing between two parts of the debt picture. First, there is the short-term debt cycle, what most people think of as the business cycle. This cycle typically lasts about 5 to 10 years. It is driven by changes in credit availability and interest rates. A period of loose credit and low rates fuels a boom, rising borrowing, higher spending, rising incomes, and rising asset prices. Over time, that expansion causes debt levels to rise and asset prices to reach unsustainably high levels. At some point, debt payments begin to bite, lenders become cautious, credit tightens, and the boom reverses into a bust. Policymakers and central banks usually respond to the bust by cutting interest rates, injecting liquidity, or using other tools to stimulate demand and get the cycle back on the upswing. The second part is the long-term debt cycle, a much slower, larger process that plays out over decades. While the short-term cycle repeats many times within a long-term cycle. It is the long-term accumulation of debt relative to incomes and productivity that creates deeper crises. Over many years, economies can borrow more and more. Households take on mortgages. Companies leverage up and governments run deficits. Eventually, total debt grows to large relative to the economy's capacity to service it. When debt loads are too high, the economy faces a deleveraging, a necessary process of reducing debt burdens through a combination of austerity, debt restructuring, or inflationary policies like printing money. Deleveraging is harder and more painful than a typical short-term recession because it involves rebalancing the entire financial system and addressing mismatches between borrowers and lenders. Another fundamental piece that anchors long-term economic outcomes is productivity growth. Productivity, the amount of output produced per worker or per unit of input, is the primary long-term driver of rising living standards. Over decades, improvements in technology, education, infrastructure, and organizational efficiency raise what an economy can produce with the same number of people. Productivity growth is relatively slow and steady compared with credit-driven swings, but it determines the economy's real capacity to grow. When productivity is strong, economies can sustain higher output and higher standards of living without relying excessively on debt. When productivity stagnates, the economy becomes more dependent on credit to generate growth. Bringing these parts together explains much of what we observe. Short-term booms and busts riding on top of a long-term trend shaped by productivity and debt accumulation. Short-term cycles are amplified by changes in credit conditions and interest rates. Long-term cycles are about the accumulation of debt and the eventual need to deleverage. Productivity forms the structural backbone that limits how much growth can be sustained without credit. Central banks and policymakers are the mechanics that try to manage these cycles. Central banks primarily influence the economy through interest rates and credit availability. Lowering interest rates makes borrowing cheaper, encourages spending and investment, and can help pull an economy out of recession. Raising rates does the opposite. It cools credit, slows spending, and helps control inflation. When interest rates fall to near zero and conventional monetary policy is exhausted, central banks can use unconventional tools like quantitative easing, buying financial assets to push down long-term rates and encourage lending and other forms of liquidity support. Fiscal policy, government spending, and taxation also matters. During severe downturns, governments can run deficits to replace lost private demand, support incomes, and stabilize the system. But fiscal responses can raise public debt and create future tensions if not aligned with productivity gains.